Hello, welcome to our continued discussion of PepsiCo's 2014 annual report. This time we're going to relate the annual report to the information discussed in Chapter 5 of your text about the multiple step income statement, the gross profit rate, and the profit margin ratio. From your text, there's an extended multiple step income statement which starts with a subtotal for net sales. And that subtotal gives you the gross amount of sales made, less any sales returns and allowances, less any sales discounts for prompt payment on account to get a subtotal of net sales. Giving this amount of detail in the income statement is not typical for companies that are publicly held that produce annual reports. After net sales, we deduct the cost of goods sold. Have we sold things at a higher price than it cost us to buy or make them, so that we get a subtotal for gross profit. From this gross profit, we have to cover all our other expenses before there's any net income for shareholders. Operating expenses consist of day-to-day operations in this line of business regardless of how we finance the business, and include things like salary and wage expense, utilities expense, advertising expense, depreciation expense, freight out, which is the cost of shipping to customers that we agreed to incur on their behalf, insurance expense, sometimes you see rent expense, and other types of items. And after you deduct the operating expenses, there's an important subtotal called income from operations. Regardless of how you finance this business or unusual items, these things occur every period, and it's a good subtotal to compare from year to year for a company. There are other revenues and gains and other expenses and losses in non-operating activities that affect the income statement. For instance, interest revenue from investments, gain on sale of plant assets, are items that would increase net income. Interest expense from financing the business, one-time casualty loss from theft or vandalism, are expenses incurred but not necessarily related to the day-to-day business. We still have to take these into account, as well as income taxes, before calculating the bottom line net income, and we're going to want to specifically focus on that available to shareholders of the company. So let's see how this works for PepsiCo. 2014 income statement. Is it consistent with the multiple step format within the text? If you look in the annual report, look at the page number 67 at the bottom of the page in the annual report after all the pictures in the 10K. And I've cut out an excerpt from this. Well, PepsiCo has net revenue, $66.7 billion in 2014, but it doesn't give you all the details about gross revenue and sales returns and allowances and sales discounts, not even in the footnotes, and this is typical. PepsiCo has a cost of sales, which is analogous to the words cost of goods sold, that it deducts before it gets to gross profit. So net revenue minus cost of goods sold is gross profit. Gross profit is about $35.8 billion. Day-to-day expenses related to running the business. PepsiCo particularly has a lot of selling, general, and administrative expenses. Note that they're a big advertiser for their products, whether it's Doritos, Quaker Oats, or soda. So we'll see that eats up a lot of the gross profit. And we have another item, amortization of intangible assets. We deduct before getting to operating profit. So after paying all the operating expenses, there are $9.6 billion in operating profit in 2014. We have these other items. Interest expense gets deducted from net income. Interest income and other gets added back to net income. PepsiCo has more interest expense than interest income and other, so this will reduce net income. We would also deduct the provision for income taxes, which is the income tax expense. And you'll see a couple of different net income items, And for the company we're looking at now, PepsiCo, and the company you'll choose for your analysis, look at net income that's attributable to shareholders that own a share of that company. For PepsiCo, that's $6.5 billion, and it excludes any net income attributable to what's called non-controlling interest, companies that we own and control but not 100% of. I wanted to point out that this was something that was discussed in Chapter 2, that PepsiCo already calculates and is required to calculate, like other publicly held companies, how much net income there is for each common shareholder. There's two numbers here, and for our analysis in the future, we'll focus on the basic one. So there might have been net income for PepsiCo shareholders of $6.5 billion if you owned one share of PepsiCo in 2014. Basic net income per share is $4.31. The number below it's always going to be smaller. It's called diluted income per share, and that's after taking into account that certain people can have stock options to maybe buy in a little cheaper than the going market price. Let's use this multiple step income statement to calculate ratios. Profitability ratios that measure the income or operating success for PepsiCo for a period of time. We'll look at the gross profit rate or gross profit over net sales. PepsiCo's multiple step income statement will make this easier for us to calculate. PepsiCo gave us a subtotal for gross profit in 2014. Even if they had not given it to you, just take net income minus the cost of sales to calculate it yourself. We have it for both 2014 and 2013, and we have net sales for both years. So let's try to analyze the gross profit rate. In 2014, for every dollar of sales, after deducting the cost of goods sold, PepsiCo has 53.7 cents left over. The 53.7 cents of gross profit for every dollar of sales must cover all the other expenses before there's any net income for the shareholders. Using the gross profit rate, PepsiCo was more profitable in 2014 than in 2013. Let's look at a different ratio. We know there's gross profit, but how much is left over after deducting all the expenses? We would use the profitability ratio called profit margin, net income over net sales. Again, this multiple step income statement makes it easier to calculate, but particularly even if you had a single step, they always give you net income. So, net income for PepsiCo shareholders, we want to calculate that which is available to our own shareholders, is $6.5 billion in 2014, and we have net sales of about $66.7 billion, giving us a gross profit rate of 9.8%. In 2014, for every dollar of net sales, PepsiCo earned 9.8 cents of net income after deducting all of the expenses. Comparing that to the 10.1% or 10.1 cents of net income for every dollar of net sales, PepsiCo was less profitable in 2014, if you use the profit margin ratio, than it was in 2013. Now, we can use this information, and you can review this slideshow to calculate gross profit rate and profit margin for your chosen company for the discussion. Good luck, and get started, Jaspers.